Hey guys, welcome to the next video of the series. And we already talked about the balance sheet, so now we're going to be talking about the cash flow statement. So, your cash flow statement, right? Let's write this down. Your cash flow statement. Before I get into the statement itself, there's a couple of concepts and I just want to give like a little spiel about like what it is and what it's used for, the three main sections that split it up: your operating activities, your investing activities, and your financing activities. We'll talk about that so we can get like a good understanding of what it is in a sense, and then we can go through each line item. So the reason the statement exists is that profit and cash are basically not the same thing, and the difference between them is that they can sink a company. They can either bring up a company or they can sink a company. And a business can either show a healthy profit in a year when its bank balance actually fell, because profit gets counted the moment you earn a sale, even if the customer hasn't paid you yet, which we've seen with the accounts payable, accounts receivable, right? And because big purchases get spread out over years instead of hitting it all at once, that's the main reason. So the cash flow statement is like a fair way to measure the performance, to see your cash inflows and your cash outflows, and you can just see how much cash is actually how much cash the business is generating. That's your main thing. And the easiest way to picture this is kind of like a single pile of cash in a company's account. You start the period with some amount, and then over the months, three main forces kind of either bring in cash inflow or bring out cash outflow. So this is going to be split into your three main sections in your cash flow statement: your operating activities, your investing activities, and then your financing activities. Okay, so let's kind of break this down on what each of them are. Your first one, right? Your operating activities is just running the business day to day, selling things and paying, for example, staff, suppliers, and just operating the business. So that's your operating section, right? Pretty straightforward. The second is building for the future or cashing out of the past, basically buying equipment, factories, anything you're investing in, or whole companies, and sometimes even selling them again. That's basically your investing activities, right? Straightforward once again. Lastly, the third, which is your financing activities, is kind of dealing with the people who fund the company, borrowing, repaying, because at the end of the day, a business is made up of either debt or equity, and every movement of cash kind of belongs under one of these three things: your operating activities, your investing activities, or your financing activities, right? Super simple. And I feel like now we can get into the the actual line items for the cash flow statement. So honestly, to give us some more space, I'm going to delete this stuff. Feel free to go back and watch anything if you need to look at it. So the cool thing is, you're gonna start slowly seeing these connections, because last time we talked about how retained earnings is coming from both your dividends from your cash flow statement and also your net income from your income statement, right? Perfectly. That's kind of like your connections. And the connection here is, the cool thing is, the net income on the income statement, your last line item, is going to be your first line item in your cash flow statement. So your net income, right? You start off with your net income. And from your net income, this is basically the profit from the income statement. Like I said before, it is our starting point, and everything below it turns that profit into real cash. So you have your net income. Let's just say your net income is 202, right? And then after this, you add your D and A. Your D&A is basically your depreciation and amortization. And wait, before this, honestly, let me split this up so we can see this in a clearer way, right? So over here, we start off with our operating activities. Your operating activities, right? Your operating activities. You start off with your net income. Let's just say, as I used an example for like just $202. And then you add your D&A, which is your depreciation and amortization. Let's just say it's 20. You may be wondering what, I think we've touched on D&A because we did talk about it in our income statement a little bit, because we did subtract out D&A in our the time we were subtracting out our OPEX, your R&D, then you also subtract out your D&A, right? And this cost basically lowers our profit because depreciation is basically a non-cash expense, and it's depreciation and amortization are non-cash expenses. So all what we do here is, since it's a non-cash expense, we add it back. And this cost basically lowered our profit, but no cash actually left this year. So we add this back. And then here you also add back your stock-based compensation. Your stock-based compensation affects the shareholder equity aspect of your balance sheet. That's another connection there. Compensation. And let's just say you add back this 15. So basically what this is you have employees and you want to pay them with something other than just cash. We pay the employees or the staff with shares instead of cash. And it's a real expense, but no money is kind of moved. So we basically add it back because at the end of the day, we're only looking at cash expenses. A stock-based compensation is a non-cash expense, right? Non-cash. And then we also add back your deferred income taxes. Deferred income taxes. Why do we add this back? We were charged this tax on paper, but basically we haven't paid this yet. So we add the unpaid part back because it's still, once again, we haven't paid this yet. It's whatever is actually on the statement itself. So we add back, for example, 6. And next, we also add something known as your asset write-downs. Your asset write-downs, or otherwise like your impairments, right? Your impairments. Say you mark an asset down in value. It can hurt profit. That's basically what happens. If you mark an asset down in value, it can hurt your profit. But basically, even if you do this, your cash is not going anywhere. So we also add this back. You're basically adding stuff back that could affect it if it wasn't a cash flow statement. But since we're only talking about liquid cash in the business, we're adding back any non-cash expenses. So these are all your non-cash expenses: your D&A, your stock-based compensation, your deferred income taxes, and also your asset write-downs and impairments. Right? Super similar to what D&A is, but it's also another thing, your asset write-downs and impairments. Here, we also, plus or minus, this depends because it really depends on your asset sales, but this could be either your gains or your losses on asset sales, right? Say that you, for example, lose money on asset sales, it's a loss, you subtract out a 3. If you gain money on an asset sale, you add a 3. Because let's just say in this situation, 3 is the asset sale. This is basically the profit from selling equipment and it is counted lower down in investing. So we take it out here rather than counting it twice. That's basically what this is. It's just your sales, your asset sales, right? So let's just say that they incurred a $3 loss in asset sales. We put that in parentheses. And then after that, this entire section is a little long because I just want to touch upon everything. So you have your asset sales, right? Next, you're going to have your increase or decrease in accounts receivable. This is tying back into the balance sheet once again, so your accounts receivable. And let's just say there's you subtract out 30. What this means is customers kind of owe us more than before. So we booked up the sale, but the cash hasn't arrived. It's still tied up. So the money is still tied up, but this just means that since it's not on hand, it's not liquid yet, the cash does go down. So it depends. It's an increase or it could be a decrease, right? Next, this also comes down to your increase or decrease in your inventory, right? Your inventory. So let's just say we bought stock that hadn't sold yet. So the real money is actually still there. It's sitting on the shelf, but your cash hasn't arrived yet. So your cash does go down. So you would have to subtract out, for example, let's just say 18. And then next, we're basically just going list by list on your balance sheet. You're going from your prepaid expenses, your accounts payable, accrued expenses, deferred revenue, taxes payable. So it's pretty straightforward. I'm not going to go through every single one, but you can go line item by line item, and each line item basically kind of affects the cash flow statement in a way. We'll talk about that in the next video a little more. I just gave a couple of examples from whether it's your accounts receivable or your inventory, or for example, your prepaid expenses. It could either increase or decrease there because, for example, say you subtract out $5 in prepaid expenses. What this means is you paid in advance for things like rent. So cash has left your account early. It's a cash outflow. So that means your cash goes down. That's basically how it is. And at the end of the day, let's just say you do all this stuff. So 202 plus 20 plus 15 plus 6 plus 4. You add back your, sorry, that is a terrible bracket. But say let's just add back all your non-cash expenses, right? And then you increase or decrease, you either add or subtract. I'll just write all of them down. You add and subtract any increase or decrease. You add or subtract any increase or decrease in the following things, right? You can do it in your accounts receivable. You can do it in your inventory. You can do it in your prepaid expenses. Just think about how, if the cash is leaving the business or if it's staying inside the business or if it's tied up somewhere or if it's actually on hand or it's liquid, right? Then you also have your accounts payable, right? For example, you could like add it back if you take goods from suppliers but they haven't paid them yet. So we're basically holding on to their cash in a way. So your cash in the business goes up. That's just how you have to think about it. It's a different way of thinking about things, but that's how you have to think about it. You also have things like your accrued expenses. If you don't know what any of these are, please watch the last video. We go through it in a lot of depth. We have your deferred revenue, your taxes payable, right? So any of this you can either add or subtract depending on the situation, whether your cash in the business is going up or the cash in the business is going down. You just have to think about it. I think it requires maybe a little bit of practice to kind of get a hang of things, to understand whether if a certain activity increases the cash in the business or decreases the cash in the business, right? So you have all this stuff. Once you do this, let's just say there's 22, you add back 5, you subtract out 5 in prepaid expenses, add back 22 in accounts payable, add 8 in accrued expenses, add 12 in deferred revenue, and what's the number? We can do add back 3 in taxes payable. You're gonna get, I think it's from, if I'm doing the mental math right, you get 236, and this is your cash in your operating activities, right? Your operating activities. This is basically the real cash the core business generated, because it's your operating activities. How much cash your operating activities is generating, that's your core business aspect. It's $236, which is against a profit of 202 from your net income. And that's super important when you're accounting for cash inflows and cash outflows. So number one, your operating activities, right? Let's just say it's 236. Let's go to the next page now.